Trading's like a big jigsaw with lots of different pieces to it, and one of the pieces that reveals important clues as to the bigger picture is support and resistance. So I'm going to spend a bit of time today during this video talking about, and I'll show you how to draw high probability support and resistance levels on your charts, so that it gives you a good foundation for your trading and beginning to understand exactly what's going on in the marketplace and how to plan your trades. So the first question is, why do you want to draw support and resistance levels on your charts, I guess? Well, all professional traders and large institutions use support and resistance levels, and as home-based traders we need to do what the big market players are doing and understand why they do it. This is the way that we're going to generate profits, by piggybacking, if you like, on the trades made in the market by traders and institutions with sufficient funds at their disposal to influence price movements. Traders use support and resistance levels to trigger trades and to set their targets, and importantly they also use them to set their stop losses, which will obviously help them to get out of their trade if the market goes against them. So support and resistance levels play a really important part in every market and on every trading time frame. So whether you're day trading or swing trading, finding high probability and drawing high probability support and resistance levels is a key skill to have, and it should be part of your daily trading ritual. So support occurs when market prices fall to a certain level and then they're held up by significant buy orders, and resistance occurs when market prices rise to a level and then they're prevented from moving any higher due to a big volume of sell orders. There are different types of support and resistance, and we're going to discuss the horizontal support and resistance levels today. And there are also sloping support and resistance levels, which are often referred to as pattern lines or trend lines, and also dynamic support and resistance levels, which are created largely by average prices and reflected on charts by moving averages. So rather than referring to them as support and resistance levels, we should actually probably call them zones, because whilst we can identify a specific level as likely to provide support or resistance, prices are more likely to stall somewhere around a certain level rather than exactly at that level. Sometimes they do stop at the level exactly and then they turn around, but more often than not, price is going to react to the level in a zone somewhere around it, either above it or below it. We never know precisely how price will react to a certain level until it reacts, which is frustrating, but it's a fact, it's true, it's the truth in trading. And what we do know is that some kind of reaction is likely at these levels, and therefore we can plan our trades around these levels accordingly. There are three likely scenarios for a price reaction to support and resistance. So price stalls and reverses, that's the first scenario. Price stalls and then stays at that level in what becomes a congestion zone. And price moves straight through the level, and after a short pause, maybe even a micro pause, it just keeps on going. Support and resistance levels create trading ranges, and a trading range is a set of prices with a resistance level above and a support level below. Prices can stay in ranges for a long time, and markets are range bound far more than they are trending. Traders typically wait for a reaction from prices at support and resistance, and when they get their signal, then they buy at the low of the range, trading the market back up to resistance, and they sell at the top of the range, trading prices back down to support. Whilst in a trend, a market's likely to power through minor support and resistance levels almost as if they don't exist. Although it's worth bearing in mind that all trends end at a major support and resistance level. So let's go ahead and find out what makes a high probability support and resistance level then. Well, any level that is highly obvious to all traders automatically becomes high probability. Don't forget that just because a level's high probability, it doesn't necessarily mean that the market's going to necessarily react in the way that you might expect. There are no guarantees in trading. So the first sort of levels that you want to identify on your chart are round number support and resistance levels, and these are the most obvious levels in trading. Round numbers can be whole dollars or half dollars in stocks and commodities, and they're the 0, 0 and 50 levels in indices and in Forex. Everybody can see them on their charts, and so they're always likely to play a part when prices are round about that level. So seek out round numbers on your chart and plot your lines accordingly. You might like to assign a special colour of line to identify the different levels, or a certain thickness of line so that you can see them easily. When you're day trading, the open, the high, the low and the close of the previous day's session are important support and resistance levels. These are referred to as the daily levels. So the market open, the high, the low and the close levels of the previous trading day, and they can play an important part in the following day's session. The daily high and the low reflect the extremes of value, if you like, during the previous day, and the open and the close reflect where the market participants perceived value to be at the beginning and at the end of the day. Many orders are taken overnight and they're filled when prices reach these levels, these values levels, during the trading day. They act like magnets for prices, and they suck prices quickly up to them, and then they repel them equally as quickly. And the third type of high probability support and resistance levels are swing highs and lows. So go to your preferred trading time frame and use the historical information on your charts to identify where the market has turned in the past, because these are the previous swing highs and swing lows. You might like to condense the bars on the charts so that you can get the bigger picture and pull these levels out a little bit more easily. Pick out the levels that have had the most influence over prices, because there will be levels that have caused a reaction time and time again. These are the high probability support and resistance levels. Go to a higher time frame, say 5 times longer than your trading time frame, and notice where the market has produced spikes, because spikes are important in trading. These are the footprints of institutional traders. They indicate where there's been a significant level of buying and selling which has supported and resisted price movements. Sometimes a market crashes down to a certain level in what would appear to be an unstoppable manner, and then seemingly out of nowhere they stop, and then the market reverses, and this is what causes the spikes. When we can identify where the big players are supporting and resisting prices, then we've got a high probability level, because they will likely, but not certainly, of course, they'll likely do the same thing again if prices revisit this level. Finally, in terms of these levels, we can easily add the pivot point indicator to our charts. The 7 pivot points are calculated using the opening, high, low and close prices from the previous trading day, and they tend to represent what the market may consider as levels of value and extremes of value. When market prices are in the vicinity of one of these levels, they rarely pass the level without some kind of reaction. And this is exactly what we would expect from high probability support and resistance levels. Whether price passes through the level eventually or turns around again, well, we'll just need to wait and see. However, having the levels on our charts, then it gives us an advantage and further context for our trades. So there you have it. Now you've got your high probability support and resistance levels for your charts, and these levels are going to provide you with context for market prices and context for your trades. Now all we have to do is wait and see how prices react at these levels to pick out the trading opportunities. I hope that you found this useful. If you have any thoughts or questions, then leave a comment below and I'd be interested to hear your thoughts. Please subscribe to our channel for more of these type of videos, and I look forward to providing you with further pieces to this fascinating jigsaw that is the world of professional trading.